1. Background and overview, 800 to 1,000 words. 1.1. Economic conditions leading to the crisis. Global economic environment before the crisis, 2000 to 2007. Robust economic growth, housing boom, low interest rates, and rising consumer debt. Deregulation of financial markets. The role of government policies in promoting financial innovation and risk-taking. 1.2. Housing market and subprime mortgage lending. The U.S. housing bubble. Overinflated housing prices and speculative investments. Subprime mortgages. Definition and risks associated with lending to borrowers with poor credit histories. Mortgage-backed securities, MBS, and collateralized debt obligations, CDOS, how they worked and contributed to the crisis. 1.3. Role of financial institutions' investment banks, e.g., Lehman Brothers, Bear Stearns, and their involvement in risky financial products. The role of credit rating agencies in misrating risky assets. Mortgage lenders and the growth of unsustainable loan practices. 2. The unfolding of the crisis, 1,500 to 2,000 words. 2.1. The initial signs of trouble. Early indicators of distress in the housing market, 2007 to 2008. Rising mortgage delinquencies and foreclosures. First failures, Bear Stearns and the collapse of Lehman Brothers. 2.2. Bank failures and the collapse of Lehman Brothers. Detailed account of Lehman Brothers' collapse and its trigger effect on the global financial system. The role of other financial institutions, AIG, Merrill Lynch, and the government bailout of major players. 2.3. Global spread of the crisis. The interconnectedness of the global financial system. How the crisis spread worldwide, affecting banks in Europe, Asia, and other regions. Bank runs, liquidity crises, and stock market crashes. 2.4. Government responses and bailouts, U.S. government intervention. The Troubled Asset Relief Program, TARP, and other rescue packages. Central bank actions, interest rate cuts, quantitative easing, and emergency liquidity support. Global responses, how other countries and international institutions like the IMF responded. 3. Key factors contributing to the crisis, 2,000 to 2,500 words. 3.1. Financial deregulation removal of key regulatory measures. The Gramm-Leach-Bliley Act, 1999. The repeal of the Glass-Steagall Act. How deregulation enabled risky practices and excessive leverage in the financial sector. 3.2. Risky financial products and complex derivatives. The creation and sale of financial products like MBS, CDOs, and credit default swaps, CDS. The role of these financial innovations in amplifying systemic risk. 3.3. Rating agencies and mispricing of risk. The role of credit rating agencies in underestimating the risk of mortgage-related securities. The conflict of interest faced by rating agencies due to their compensation models. 3.4. Overleveraging and excessive risk-taking. The practice of borrowing and lending beyond reasonable limits. How banks and financial institutions overleverage themselves. Consequences of excessive risk-taking by financial institutions. 3.5. Failure of risk management and oversight weaknesses in risk management frameworks within financial institutions. Inadequate government oversight of the banking and housing sectors. 4. The economic and social impact of the crisis. 1. The Volcker Rule and other efforts to limit risky activities in the banking sector. Global financial reforms, Basel III, and efforts to improve the stability of financial institutions worldwide. 5.3. The impact on global financial markets and the banking sector. Structural changes in global financial markets. Increased regulation, greater transparency, and risk management. The rise of alternative financial models, peer-to-peer lending, shadow banking, and fintech. 5.4. Recovery and growth post-crisis. The slow recovery process, how different economies emerged from the recession. Economic shifts, from high-risk speculation to more conservative banking practices. Lessons learned, how the financial system was better prepared for future crises. 6. Long-term lessons and conclusions, 800 to 1,000 words. 6.1. Lessons for financial regulation and oversight. Importance of robust regulation to prevent excessive risk-taking and ensure financial stability. The need for proper risk management within financial institutions and across the global financial system. 6.2. The role of consumer protection. The importance of safeguarding consumers, particularly in financial products and housing markets. Lessons on ensuring that financial products are transparent and accessible to all. 6.3. Understanding systemic risk. The role of systemic risk in the crisis and the need for early intervention to address large-scale financial instability. 6.4. Conclusion. Final reflection on how the 2008 financial crisis reshaped the global economy and financial system. The importance of understanding the crisis to prevent future economic disasters, reaffirming the need for continued vigilance, regulation, and reform in financial markets. References and further reading. A comprehensive list of academic papers, books, articles, and reports that provide deeper insights into the crisis and its aftermath. The 2008 financial crisis offers numerous lessons that are crucial for both policymakers and financial professionals to understand in order to prevent similar events from occurring in the future. Below are key lessons learned from the crisis. 1. Importance of financial regulation. One of the most significant lessons from the 2008 financial crisis is the necessity of robust financial regulation. Deregulation, especially in the years leading up to the crisis, allowed financial institutions to take excessive risks without adequate oversight. Lesson: governments must ensure that financial markets are well regulated to prevent risky behavior and maintain stability. 2. The danger of excessive risk-taking. Many of the financial institutions that collapsed in 2008, such as Lehman Brothers, were highly leveraged and took on far more risk than they could afford. The complex financial products they created, like mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, were risky and poorly understood by investors. Lesson: excessive risk-taking, especially with borrowed money, can cause major financial instability. It's important to ensure that businesses do not take on more risk than they can handle. 3. The need for transparency. During the crisis, many